Hello and welcome to the Q&A for the latest issue of the Rural Investment Newsletter with me, Paul Harris, and of course, Rick Rule. Hi, Rick. How are you?
Paul, I'm very well, thank you. And thank you for this wonderful edition you just turned out.
It's great to see you. Look like you've recovered well from the hectic few days we had in Boca Raton. You're looking very pink and shiny again.
Well, I actually get energy from the event. You can't see it by the end of the event because physically I'm drained, but certainly I enjoy doing it. I enjoy interacting with our subscribers, with the exhibitors. It's a very fun event. So I'm delighted I've done it. As you point out, by the end of the conference, both you and I think we're running on fumes, but a day of rest fixes all that.
Absolutely. It was a fantastic event. The issue we've just published in the Rural Investment Newsletter contains some of the highlights from that, where the event was early this month. Some sort of 2,000 people participated in person and virtually. If you missed it, don't worry, you can still register to access the content on demand. And I suggest you do, as there are a dozen hard-hitting presentations and extra bits on the live stream interviews that I hosted. Next year's event is going to be the week of the 6th of 10th of July in Boca Raton, and we'll be making registration links available for that in due course. Now, this is a Q&A, so please submit any questions you may have in the Q&A tool. Before we get to that, we're going to do a bit of an overview of what some of the key things that I picked up on from the conference, and hopefully Rick will share some of his insights too. As a reminder, of course, you can subscribe to the newsletter via Substack at realrickrule.substack.com. Meeting with potential investment opportunities is one of the purposes of the Rural Symposium, but perhaps the main draw are the opportunities to get an orientation to the macroeconomic investment environment from some leading experts that determine how investment hypotheses, such as investing in precious metals, will play out going forward. Rick programmed some of the highest powered and most reputable analysts and experts in the world for the symposium, and the collective knowledge, experience, and wisdom there on display is staggering. And this is not only or just confirmation bias, as there are different perspectives presented. Take US President Donald Trump's recently passed Big Beautiful Bill. Jim Rickards, editor of Strategic Intelligence for the Paradigm Press Group, he defended the bill and gave an introductory class to what he called Maganomics or Trumponomics, piecing together the program that he said the rest of the world does not properly understand. We hear a lot about the US debt on news channels, and while 37 trillion US dollars is an incomprehensible number for most, that's about 108,000 US dollars per capita or $323,000 per US taxpayer. It tends to be viewed in isolation from other factors. This was the argument that Professor Joel Littman, CIO at Altimetry Research, shared with us during his presentation. And he says the view of the US, in his view, the US does not have a debt problem, observing that the rest of the world has more debt than the US, and that the US is the best able to service its debt going forward. The US is forecast to collect 51% of global tax revenue in 2035, up from 32% in 22, obviously much more than the rest of the world combined. The effectiveness of Maganomics was rebutted by David Stockman, who served as the director of the Office of Management and Budget under President Ronald Reagan, and who presented some frankly scary numbers of how the Big Beautiful Bill, in his opinion, would impact the US balance sheet to the cost of all Americans. Stockman estimates that the real cost of the Big Beautiful Bill in 10 years will be 5.5 trillion US dollars, and that will see interest on public debt approach $2 trillion by 2034, which is some 4.5% of GDP. Debt as a percentage of GDP will increase from 117% to 130% in 2034, with the deficit to grow from 29 trillion today to 55 trillion. He said the number that dare not be spoken is that by 2050, debt surges to 218% of GDP, which represents about $185 trillion of public debt. Who pays for that? Asked Stockman, the unborn taxpayer in 2035. Stockman said a big, beautiful, balanced budget is possible, but that will require spending cuts, particularly to the military, and means testing entitlements such as Social Security, Medicare, and Medicaid, so the rich don't get them. And of course, a blanket 20% import tariff. Those are some of the standout macroeconomic moments that I picked up on from the conference panel. I want to bring you in, Rick. You obviously come at this from a much more expert and experienced viewpoint and knowledge than I have. What were some of the things that particularly impressed you or that you learned at the event?
I would disclaim your introduction of me. I'm an investor. The beauty of that panel is that they were all participants in macroeconomics. Jim Rickards, as an example, was general counsel for Wall Street long-term capital management, whose failure damn near brought down Wall Street. David Stockman was the director of the Office of Management and Budget, now the Congressional Budget Office. He knows more about budgets than any person alive. I'm an investor, and I try to talk about the budget and global macro from the point of view of an investor. I would say my own discussion, introducing everybody, was merely that debt in the absolute was ugly, but debt as a percentage of GDP and the change in debt as a percentage of GDP is what scared me. In 1982, the on-balance sheet liabilities of the U.S. government were about 30 to 32% of GDP. Now they're 120 or 130% of GDP. The off-balance sheet liabilities of the federal government, which is to say Medicare, Medicaid, Social Security, federal pensions, military pensions, that number is scarier yet, north of $100 trillion or 3.5 times GDP. The ultimate debt number is scary, but debt with regards to our ability, the ability of our economy to repay it is problematic to me. I think Joe Littman said an interesting thing, which is that we have greater capacity for debt than the rest of the world. That reminds me absolutely of Doug Casey's suggestion that the U.S. is the prettiest mare at the slaughterhouse. And I'm not comfortable myself being relatively attractive if the whole crowd is unattractive. I need to say that. In terms of the disputes between Stockman and Rickards, I come down very stolidly on the Stockman side. It's interesting that when Daniela posed the question to the panel, so what do you do about it? Even Rickards, the bull, if you will, said the only answer is gold. Now, partly that might have to do with the bias of the person who selected the panel, which is to say me. But it's interesting that with the exception of Littman, who I think would suggest the S&P 500, the solution to the predicament, if there is a predicament and if there is a solution, was roundly and universally gold. For those people listening to this discussion, I really truly urge you, if you didn't attend the conference either in person or online, to order the tapes. Remember that the recordings of the conference come with a full money-back guarantee. And with regards to the first panel, I would, of course, urge you to listen to all of it. But I would urge you particularly to listen to David Stockman, whose knowledge of the budget I think is unequaled, having participated in the process and also, of course, been a congressman. And I would urge you too to listen to the presentation by Grant Williams. I say that with some hesitancy because I think Grant will outpoll me as best speaker at my own conference again. But I thought his discussion of the inevitability of change and the duty of each individual to prepare himself or herself for that change, to make themselves anti-fragile. And particularly his discussion of the changing of an epoch, in effect, from the period 1982 to 2022, the most benevolent investment climate in human history, and how that circumstance had in fact changed post 2022 was very useful. It reminds me of the quote from my friend Robert Friedland, who unfortunately couldn't participate this year, when he said some years ago, as you describe it, the situation is hopeless, but it need not be serious for you if you're prepared. I think what the macro panel suggests really is that you need to be cautious. You need to plan your future in a less benevolent economic climate. If you are preparing for retirement, I think you need to understand that the currency will be debased in the next 10 years and that the social safety net that we've come to rely on for the last 100 years has big gaping holes in it as a consequence of too much debt. relative to GDP.
Now, in terms of looking at the tapes, it's really worthwhile looking at David Stockman's presentation and Professor Joel Lippman's presentation, because they both included a lot of charts that, as I was sitting there, it's very difficult to ingest all the information there. Obviously, with the tapes, you can hit pause and read and cogitate and ponder the data that's being presented. I would very much recommend that. We also spoke a lot about investing, and a couple of things that really stuck out in my mind, Rick, when you were talking with Amar Al-Jundi, who's the president and CEO of Agnico Eagle Mines, the most valuable gold company in the world at the moment, you reflected that although the company's share price has gone up, or had gone up more than 100% since the 2024 Rule Symposium, it was still cheap, or it was cheaper at this year's event than last year's event due to the movement in the gold price. This is a thing that perhaps some people find hard to believe, given that 100% gain in the share price. How can it be cheaper today? Talk us through sort of some of the logic there.
Well, Paul, the most standard conventional way to do natural resource company evaluation is on a net present value basis. Price earnings is a less attractive measure because natural resource assets deplete. There can be no assurance in the future that the earnings that you enjoy this year are repeated in the past. So it's important that in valuing natural resource companies, you look at the value of measured and indicated and perhaps partially inferred reserves and resources, and you estimate revenues versus costs, and you do a net present value on the free cash flow, applying a discount to future years' cash flow. By that measure, the net present value of future cash flows at Agnico Eagle, measured by the current gold price, which is to say $3,300 an ounce, is substantially higher than the net present value of Agnico Eagle's cash flows measured a year ago at $2,250 an ounce, which is to say, if you adjust for the current gold price relative to the gold price a year ago, Agnico Eagle, despite having more than doubled, is actually cheaper in relation to its net asset value than it was a year ago. Many people who are used to doing security analysis in other industries, who don't really need to understand net present value and also the tail value at the end of the net present value, are uncomfortable, I guess, with a metric where a share price doubles, but the company is still cheaper than it was before the share price doubled. But what you learn over time in natural resources is that net present value is critically important, as I say, because of the terminal nature of this year's earnings.
Okay, and one of the sort of key things to sort of bear in mind there is that when you invest, you're looking for the best opportunity today. And if you get anchored on a share price gain, or what it was, or what you think it may be, you can miss the wood for the trees. You've got to look at the value today that an opportunity presents, and not get anchored on the fact it's gone up 100%. It could still go up another 100%, for example. Let's move on. You had a very interesting panel, which you called the Investor Legends panel. And one thing that really stuck in my mind from this, Frank Juster, he's been very, very successful in the sector. He's founded many companies. He's had a lot of success. Recently, he's launched or put together a $1 billion sort of digital gold-backed initiative. But that wasn't really what stuck in my mind about his comments. His comments were that, and it's a little bit related to what we've just been talking about valuation. He said the biggest mistakes he's made in the past is because he didn't check his ego in the door when he went into a new venture. Specifically, he was talking about when he invested in a film studio. He said he thought, he was a big shot, he knew it all, he made a lot of money, and consequently, because of that, he made a lot of very expensive mistakes. Let's sort of riff on that a little bit, Rick. How negative can ego be when you're evaluating investments opportunities? It's not easy for everybody to have complete sang-froid and ice in their blood when they're looking at things, because obviously they're putting their money on their line. They're perhaps putting some of their retirement savings on the line. How how can investors perhaps get a cooler head when they're looking to invest?
I think investors who have enjoyed success and as a consequence come to believe themselves to be good investors need, as they consider new investments, to refresh their memories on the process that they used before they had that confidence. The lessons that Frank lost when he went into Lionsgate were lessons that he had already learned at Yorkton and other places. Because he believed in himself, he believed that he could shortcut the empirical processes in favor of intuitive processes. Now, over time, he worked his way out. He's a hard worker. He is willing to write checks when checks need to be written. And he's a very, very, very smart guy. What he said rang true with me because I've watched it happen to myself. In my early years, in my 20s, I was extremely successful. And but most of that success had to do with the fact that I was existing in the 1970s, the greatest bull market in resources in the history of humankind. And I came as a young male to conflate a bull market with brains. When commodity prices declined in the early 80s, I found out just how smart I was, which is to say, not very. The sort of empirical processes, the sort of terror that went into my investment decisions in 1973, 1974, and 1975, had I followed them, would have saved me the shellacking I experienced in 1982 and 1983. And the good news is that those scars, while deep, occurred while I was young. And they have caused me ever since to be a better natural resource investor. What I have learned, and what I hope everybody listening to this call learns, is that markets work. In every case, the cure for high prices is high prices, and the cure for low prices is low prices. Fundamentals don't always appear on a quarter by quarter basis, but fundamentals certainly occur and appear over 4 or 5 years. Further, we learned on that panel from everybody, the importance of persistence and tenacity. We all respond to newsletter promotions that talk about tenfold gains in 3 months, and they occur 2 or 3 times a decade. But we're going to miss them mostly. I believe for myself, and I heard from the other panelists on the Investing Legends, that the key to success is to do very, very, very hard initial work, and then hang on for dear life. Be persistent, be tenacious, but be prepared if the facts on the ground change to sell, including for a loss. We heard that time and time and time again. Don't be afraid to be right, but don't assume you're right. Do the work to begin with, and be prepared to continue to do the work and make new decisions all the time. If the share price falls, but your interpretation of the valuation of the company and the future valuation of the company is unchanged, that isn't the time to sell. It's a time to buy. It takes guts. But as the famous Adolf Lundin said, no guts, no glory.
I think a point to add on to that is to be cognizant of the time horizon for your investment to mature. We're in the mining sector. It can take a number of years for a discovery to become a resource, for a resource to become a preliminary economic assessment or a feasibility study, and then more years for permitting and to build a mine. So expecting a stock to go up rapidly in a short space of time is perhaps unreasonable. So you need to be attuned to the investment horizon, the timeline for what you're investing in. And that this is a Q&A, so it brings us to perhaps a nice moment in time to bring in some questions from the audience. We have one that's very, very relevant to what we're talking about right now, Rick. And that is somebody asked, I'm doing my best to study natural resource investing, but it's hard for a beginner to keep up with only a couple of hours a month per company, learning about grades, what they're doing, etc., and the overall environment. What would you give? What advice would you give? And I believe I know the answer to this, but what advice would you give to somebody that doesn't have a lot of time to commit to studying particular metals or particular geographies or particular companies and really staying on top of what they're doing or not doing?
Well, this is self-serving, but I would start at the rural classroom with Introduction to Natural Resource Investing, which tells you how to spend that time better. I would tell you too that everybody has to start. Um, Despite a university education, natural resource finance, it took me the better part of 10 years to really become great at the sector. It took me 5 years to be competent in the sector. So I would say soldier on. I would say certainly do not own more stocks than the number of hours per month you spend studying those stocks. And when I say studying stocks, sadly, I don't just mean reading our newsletter. I mean reading the quarterlies, reading the annual reports, calling into the quarterly analyst calls, reading resource reviews, looking at proxy statements, digging into the company. Mostly investing is common sense. And always keep in mind in the background, always keep in mind the contrarian, cyclical, capital intensive nature of resources. Don't always look for what's comfortable. Don't always look for what's in favor. Don't always look for what has momentum. Look for what's out of favor. Look for what's cheap. You spoke earlier, Paul, about stocks that gain a lot of, get a lot of market cap, go up very quickly. You should likely be looking at those as sells. You need to juxtapose the price to value. And if the share price doubles with no change in the underlying fundamentals, very often you're well advised to sell at least half of your stock so you can get the other half for free. If it keeps going, God bless, you still have the other half. But understand that making money in this sector is merely an ongoing discussion of the delta between price and value. Learning how to do that is something that you just have to do by doing it. I would also ask that you propose specific questions in the question section at the Rural Classroom. When I have time, when I'm not speaking at a conference, I'll do my best to point you to the answer.
Okay, now you make a lot of good points there, Rick. One I think is that is often overlooked is when you make an investment, have an idea of what your potential exit point is. Whether it's if the stock doubles, do I get out then, or do I reevaluate what it's doing and perhaps if there's still looks like there's upside, you stay with it. But I think it's important to identify what may be an exit point, what would determine success for you as and when that event occurs. And perhaps as a follow-up to the question, researching companies and information and what's happening in markets, it is addictive. It can become all consuming. So your a couple of hours per month, I imagine, is going to grow as you get more and more into it. We have a question from a younger investor, and he says he's just starting out. He's got a balanced portfolio, but he's thinking of a 20% allocation to speculation in resource equities for hopefully asymmetric returns. I think it's good to sort of bring in sort of younger investors. They're obviously starting from a very different point. They've got hopefully a long life ahead of them, perhaps more open to risk than somebody that's perhaps in their twilight years or approaching retirement. What sort of advice would you give to younger investors in terms of, that they're perhaps in a position to go all in on resource stocks, but should they?
Well, I mean, ultimately, you would find a stock that's good enough to go all in on. I have never found that stock in 50-something years of trying. Buffett famously says, put all your eggs in one basket and watch that basket very closely. I have never found a stock that was good enough to go all in on. I would say to the younger investor, and this is personal, when I was a young man and I had a lot of time left on earth, I was extremely impatient. Now that I'm an old man with much less time on earth, I've become much more patient. It isn't because I don't have time preferences. It's merely because I've observed markets for 55 years. And I know as a speculator, multi-baggers, which is why you play the game, 10 baggers, 20 baggers, 30 baggers, those things take time. You are answering a series of unanswered questions. Sometimes 4 or 5 yes answers in sequence is required to get your 10 bagger. And every one of those questions might take a year or 18 months to answer. So, Paul, you had said earlier, it's important to correlate your time frame, your investment time frame, with time frame that's required for your investment to mature. Young people have a huge advantage in that the eighth wonder of the world, but the first wonder of the investment world is compounding. And in the right company, good news builds on good news. Uh, and so you need to let that happen. It's important too, as a young person, that you understand that the most important investment that you can make is in yourself, in your knowledge, in your reputation, in your community. It's important that curiosity is important to you. It's important to get yourself to the place where you can't help but study, where it ceases to be work, and it becomes sort of an all-consuming sport. Uh, that's what happened to me, and that's when I began to enjoy the sort of fulcrum effect of knowledge and time on my portfolio.
I would agree with that. That sort of happened to me 30 years ago, and here I am still in the resource sector. But I think it's also, echoing again, when you do your evaluation of a potential investment, you hopefully identifying what potential catalysts for value increase are and at what moments of time they may happen. So you've got these various different sort of catalysts or benchmarks or milestones that you can look for and hopefully plan for and invest in accordingly. Now, this is, I think, a very good question. Rick, you've obviously been doing this a long time. You had more than 50 companies, issuers invited to the conference to talk about their businesses. I know you invest in a lot more than 50 companies. Question is, how do you keep track or oversight on your investments, so many investments? What system, if any, do you use to help you with that?
I pay no attention to day-to-day share price moves at all. I'm not one of these guys who's a slave to his phone for stock quotes. For companies that I'm especially comfortable with, the Franco-Nevadas, the Wheaton Precious, the Agnico Eagles, I might look at the share price, I don't know, every 3 weeks, every 4 weeks, and not really with any particular interest. I spend a lot of time on the annual reports. I spend a lot of time on the quarterly reports. I spend a lot of time on the analyst phone calls, including when appropriate, calling them myself and doing work in them. Every time I buy a stock, Paul, particularly a small stock, I write myself a 1 or 2 page memo, handwritten, throw it in a file, talking about what I buy it, why I bought it, what I think the near-term catalysts are. By near-term, I mean 18 months or less. What I think the longer-term catalysts are, and what will constitute a mistake. How will I recognize a mistake? What will cause me to sell it? We're in a bull market now, make no mistake. And we are in a market right now where when the market comes to small cap stocks, you're going to see stocks go up for no reason. And when you see stocks go up for no reason, you're going to be excited. You're going to be elated. You're going to like the stock because it went up. That's like going to a store and enjoying the fact that candy bars sell for more. It's really stupid. In bull markets, you have a circumstance where you believe if you get a yes answer to an unanswered question, that the stock might double. And in fact, the stock doubles in anticipation of the answer, which is to say nothing other than the share price has changed. When that circumstance happens, you have to be mature enough to sell some stock. It's wild that when stocks go down, if nothing changes, people want to sell them. In other words, as they become more cheaper, as they become cheaper, people want to sell. And as they become more expensive, people want to buy. You need to take the backside of that trade. It's important that you develop the emotional maturity to take the backside of that trade. And it's important, too, that you invest enough in your own education that you recognize that trade. You recognize that money is made on the delta between price and value or price and expected value.
I think that's really sage advice, Nick. Just, Rick, something simple as writing down why you've bought something and what the next couple of catalysts are. From my own experience, I've had things I've looked at my portfolio and thought, why on earth did I buy that? I can't remember. So that's part of the discipline. And I think one of the other things that came out from the conference is the fact that is discipline. You have to be disciplined in your information gathering, how you're allocating your capital, when's the time to sell. We have a question in from another young investor saying, when's the time? How do you determine the time to sell? Because he's afraid, presumably it's a he. Sorry, no, it's a female, Lisa. She's afraid of selling too early. And I think, without wanting to be too crass, you're never going to go bankrupt. You're never going to go bust if you're selling for a profit. You're never going to be able to pick the absolute top of the market. So if you sell for a profit, be happy with that. file it away mentally and move on. Would you add anything to that, Rick?
No, absolutely. I mean, there was a great investor named Bernard Baruch who noted that the only person who ever bought at the bottom and sold at the top was a liar. It didn't happen. To me, money is made, as I say, in the delta between price and value. There are some times when my opinion is to value and the market's opinion to value is very different. But I have to go on my own counsel. The market isn't a source of information. It's a facility to buy and sell stock. And money is made on the delta between price and value. That's hard enough without handicapping yourself by the opinions of 10,000 people, most of whom know less than you do.
Okay, now this is a good question here. We've spoken about the Mining Legends panel. Last year you had the Mining Legends panel, sorry, the Investor Legends panel. Last year you had the Mining Legends panel. We got a question, and this is something I believe we're going to address in next year's event. We talk about Robert Friedland, Adolf Lundin, Eric Sprott, and of course yourself, Rick, as mining legends or investor legends. The question is, who should people look to as the potential future legends? And I believe we can have a future legends panel next year. I know that's about a year away still. Who are you thinking of perhaps inviting to participate in that panel?
Well, I don't want to steal the thunder from that panel. Certainly, the continuum between mining legends and legends of the future is represented by the Lundin family. My first transaction with the Lundin family took place in 1974 at the ripe old age of 21. I'm delighted to say that I'm doing business with the grandchildren of Adolf Lundin then. I've had Adolf Lundin on my podium. I had his brother Lucas, or his son, pardon me, Lucas Lundin on the podium. And next year, I hope to have the grandchildren on the podium. This is an amazing family where the grandchildren of billionaires are hardworking, smart, and humble. Certainly, I think there's a place on the panel for Amir Adnani, a fairly young man who launched his first public company at age 26, has been serially successful, probably raised $1 billion in his young career. But we're looking for people who have legs left, who have 15 or 20 years minimum left in their career, who have already been successful more than once. We are looking for people who built the track record that Ross Beatty built in his 30s, that Clive Johnson built in his 30s, that Robert Friedland built in his 30s. And there's a fair number of them out there. I've just given you a few, but the criterion would be made serious money for investors more than once. Nobody did it on their own, somebody who was capable of assembling a team, but somebody whose reputation allows them a lower cost of capital and better access to transactions in the future. It's important that you recognize that a financial brand is as important as a consumer brand. The same premium that attracts customers to high quality consumer products attracts investors to high quality investment track record. And that's what we're looking for.
Excellent. Adam Lundin is effectively the sort of the chair of the next generation of the Lundin group. Jack Lundin, Harry Lundin, they're all very much involved as well. And I think they're already making their stamp on the family business. They've been quite aggressive so far with transactions and investments in Montage, gold, in Fireweed, metals as it is now. And of course, putting together or being part of the biggest deal last year, which was Lundin Mining and the BHP getting together as joint venture partners to take forward the Vicuña district in Argentina. If that's how they're starting, they've got a good few decades ahead of them, and I imagine we're going to see a lot more out of them as time goes on. Got an interesting question here, Rick. For a lot of the juniors who that you invest in and who participate in the symposium, their business plan, their exit strategy is to be taken out by a larger company, hopefully for a premium. With the share price fall in recent years, up until recent times, a lot of transactions, even though they had premium attached to them, were take-unders for many shareholders because they were under the water. Interesting question. Someone's asking, what are some of the characteristics that tell you a company can resist being acquired in those circumstances and resist until they can get a much, much higher return. What do you look for in those kind of scenarios?
Value. If the values are apparent, core shareholders will resist a take under. It's also important that you as an investor understand that if the share price falls, the investment has become more attractive. So it might be, as an example, that you paid $2 for your initial stake, thinking that the company was worth 4 or 4.50. The stock falls to $1. At $1, a $2 takeover for you means you break even. A $1.50 takeover, $1.75 takeover means you lose money. But you don't lose money on the amount of stock that you had the courage to buy at $1. If the price changes, but the circumstances don't change, you have to be a buyer, not a seller. It's important too, I think, that you look at pedigree. There were lots of opportunities when Ross Beatty was building Lumina Copper for him to sell out too soon. There were 2 or 3 times where he ran out of money, and a group of us that were close to him, including himself, had to chip some in. The consequence of that was that a company that came to life with a $20 million market cap, if my memory serves me well, went out with a $2.2 billion market cap in 6 fairly short years. The lesson around that is that high quality people, the legends, while they don't always get it right, almost never get it wrong. One of the stocks that I have a decent sized position in right now, Sovereign Metals, has a very, very, very high quality rutile and graphite deposit in Malawi. It might be that because of their very small market cap relative to the value of the deposit and relative to the sustaining capital and development expenditures, will elect to sell out to their largest shareholder, who is Rio Tinto. My preference would be that they don't do that. My preference would be that they hang onto the deposit for 5 years or 6 years or 7 years. To the extent that that isn't what occurs, and Rio pays me a 30 or 40% premium in the interim, that isn't an awful penalty to pay. My preference would be to delay gratification and have the gratification that I receive be much, much, much larger. But if my penalty is simply being taken out at a cash premium, I can live with that. Your real risk is convincing yourself that a takeout's going to occur because you didn't do the work, and you find out that nobody will buy the stock from you at any price.
Okay, thank you. Now, we're in the second quarter reporting season. Newmont was the first company to report, and it reported a blowout quarter, which shows that the gold producers are making cash hand over fist. We've got an interesting question there, which I'm going to adapt slightly. Newmont's maintaining its 25-cent per share dividend, but it's announced an additional $3 billion share buyback, and this morning it announced it's going to tender to buy back $2 billion of its notes. The question is, given that gold companies are now making money hand over fist, why can't they raise dividends? Why are they looking to buy back stock more than raising their dividend and therefore the dividend yield?
Well, buying back stock is much more tax efficient. In the case of Newmont, they pay tax on the profits, and then you distribute to shareholders. Newmont gets taxed on the profits, and you get taxed on the dividends. Whereas share buybacks are much more capital efficient because the shareholder receives capital gains as opposed to being taxed at the ordinary income rate. So it's a much more efficient use of capital from a shareholder's point of view. The second thing is that nobody in the mining business is actually sure, with the possible exception of people in the uranium business who can enter into contracts, what the selling price of your product is going to be next year. If you raise the dividend by 25 cents as an example, how sustainable is that? The fact that you're generating substantial free cash flow now doesn't mean that 2 or 3 years from now you'll be generating substantial free cash flow. And dividends are, at least shareholders hope that dividends are sticky. One answer to that in the mining business, at least with regards to the South African miners, has been that there's a base level of dividend, and then to the extent that they have a really banner year, that they declare an extraordinary dividend. But my own preference would be that companies do what Newmont is doing, which is to say, buy back the stock. Our mutual friend, Doug Casey, says, first of all, that dividends are, quote, outward manifestations of inward grace. That's great. Buybacks are something different. When a company issues stock, they're suggesting to you that your cash is worth more to them than their equity. When a company is buying back its equity, using their cash to buy back your stock, they're telling you that your stock is worth more than their equity. That's a wonderful manifestation of faith. I need to say, with regards to Newmont, that we've waited a long time for a good quarter, and this was a truly good quarter. There wasn't as much decline in all-in sustaining costs as I would have preferred, but what you see is a trend in the right direction. You see the fact that you see the fact that they sold off their tier 2 mines, or most of their tier 2 mines. And this had a couple of good impacts. It meant that they were able to lavish their love and care and attention on their big mines rather than their small mines, and begin to get AISC under control. It also meant that I think they had a $2.2 billion budget for dispositions. They thought they'd take in 2.2 billion. They've taken in almost 5 billion, including the share sales that they've done, which is really the money that they're using for the buyback. That doesn't have to come from operating earnings. It comes from hiving off assets that, relative to the size of the whole, were irrelevant. It also clears the deck, if they needed to be able to do an acquisition of size that could give them another 1 or 2 tier 1 assets. This was, make no mistake, this was a very, very, very good quarter after 8 consecutive lousy quarters.
Absolutely. And as you mentioned, Nick, Newmont has been a bit of a middle of the road operator in terms of results in recent quarters. So it'll be very interesting to see how the better operators, such as Agnico Eagle Mine, what their results will be when they post those. One other thing about share buybacks, of course, buying back your stock makes it scarcer, which, when you divide it by the net present value, should equal a higher share price. So buying back stock should ultimately enable you to get a higher share price on your stock. And that's presumably worth a lot more than getting an extra few cents per share dividend every quarter. While we're on the subject of NPV, which you spoke about earlier, Nick, I've got a question. After watching the beginner series from Rick on the Rule Classroom, I'm having issues being able to calculate NPV, reading financial statements efficiently. Are there any resources that show you exactly how to perform NPV calculations on a natural resource company?
The answer to that is no, but I will reveal today that I am in detailed discussions with the Colorado School of Mines about a short course on natural resource company evaluation, including NPV model construction. This will not be for the tourist. This will likely be a 3 or 4 day workshop that will take place in Boulder, Colorado, in Golden, Colorado, at the Colorado School of Mines. It will, if it takes place, be simulcast. In other words, there will be a live stream recording, and the tapes will be available. This will be for serious students. This will take 3 or 4 days of your life. It will be fairly expensive, but it will equip you to be a lifelong investor in natural resources. The tapes, I think, will be very valuable because we're not going to give you stock tips, time-sensitive stock tips. We're rather going to equip you to make your own decisions over time. So pay attention. This will be a joint venture of Rule Investment Media, the Rule Classroom, and the Colorado School of Mines, if it occurs.
Well, that is really exciting. Save a place for me. And I want to paraphrase you. At the symposium, you say, part of your intent there is not just to teach people to fish, but it's to catch it, to scale it, to gut it, to fillet it and send it up, present it in a lovely dinner. But with this, you really will be teaching people how to fish and do this for themselves by the sounds of it.
Yeah, I mean, what I would like to do with the rural classroom and rural investment media ultimately is teach thousands of people the lessons that I had to teach myself over 50 years. I think that'll be a service to the mining industry and it'll be a service to tens of thousands of people. Yes, absolutely. We discuss at the rural classroom individual stocks. And absolutely, at the conference, I introduce investors to companies that I already own. I try to make their screening mechanism easy. There's 3,000 public companies that purport to be in the mining business. There's probably 200 or 250 that are worth owning. And I try to introduce you to 50 of them. But it's more important than the fact that I introduce you to 50, that you, the attendees, have the ability to sort among those 50 and find a buy list that suits your own temperament, your own time preference, and your own risk tolerance. That's what Paul means when he says teaching people to fish. That's the goal of the Introduction to Natural Resource Investing at the Rural Classroom. It's the goal of the discussion groups. It's the goal of the boot camps, and certainly it's the goal of the conference. If we do the short course on valuation, which may or may not be followed by a short course on geology, that'll be sort of grad school for investors.
Well, I really hope that comes to pass. We've had a lot of questions about individual stocks, but I'd like to remind people that Rick and Albert Liu really sort of go into that in the weekly Q&A, the Rural Classroom. So please direct those questions to Rick and Albert later this week. While we're on the subject of future possibilities, Rick, I know we're about sort of 50 weeks away from the Rural Symposium 2026. We mentioned that there's hopefully going to be a young mining leaders or future mining leaders panel. Are there other things that you're thinking about that you might like to try and do differently, do better, new things you might like to bring in for next year's event?
Well, I think the continued integration of the live stream into the main event is important. I think, too, increasing our access to the influencer and the online community is important. The online community amplifies the message of the conference to lots of people, and frankly, is a great marketing arm for us. Uh,
Excellent.
I don't want to make specific promises about content until I have reviewed the polls that we sent out to the attendees and that we sent out to the issuers. One of the things I've learned, Paul, in 30 years of putting on these conferences is that wealthy people are very generous with information as to how you could serve them better. And I look forward to hearing the rankings that my audience gives of the speakers that I have assembled. People need to know that any speaker that finishes in the bottom half of rankings, irrespective of whether I like them, is allowed to speak at somebody else's conference. One of the things I think I'd like to do, and I deliberately haven't done it in the past, is I'd like to bring a couple more large cap issuers to the conference for two reasons. I think we're in a real bull market now. And I think the beta in natural resources, I define beta as the extent to which the resource indexes outpace the broad market, will generate a lot of money for people. And for a certain kind of person who doesn't want to do the work to generate alpha, beta is good enough. I love the contributions we got this year from Randy Smallwood from Wheaton. I love the contributions that we got from Agnico Eagle. I would love to include, and I hope I'll be able to include Franco-Nevada and a couple others, so that people can see what happens over 30 years to the very, very, very small caps and how it happened. So I'd like to be able to introduce people to beta style investments, both for their own portfolio, but also for the lessons that one learns. I would say that one of the best discussions that we had, well, two of the best discussions that we had at the symposium this year were our fireside interviews with both Randy Smallwood and Mr. Aljundi. I thought those were spectacular discussions about how success is achieved in mining. And I hope to be able to continue to do that next year. If the audience was happy with the faces at this year's conference, they will likely return. To the extent that the audience was less happy, those faces will change. I think it's important too, Paul, that we talk about what I would describe as the passing of the torch. The strength of the conference for 30 years has been the fact that I, in my 30s, came into contact with the Lundin family, came into contact with Robert Friedland, came into contact with Bob Dickinson, Bob Quartermain, Ross Beatty, Tom Kaplan, the legends. These were young pups starting out when we started the conference. We've grown with them; they've grown with us. But it's important to begin the process of identifying the next generation. At some point in time, Ross Beatty, having taken the summer off, is going to take the winter off too. And he will no longer be an investable legend. The same thing with Bob Quartermain, the same thing with Rick Rule. It's important that we identify now the leaders who will take us through this next decade, which threatens to be a very, very good decade.
Excellent. Now, we've already had some good feedback on what you mentioned about the possible course, the valuation course with the Colorado School of Mines. So just based on this very, very small sample, it seems that that's a good idea and has some legs to it. We've had a number of questions, as I said, about asking you about specific stocks, one of which is Banyan Gold, which participated in the conference. We're not going to talk any more about that right now, other than to say that next week I'm heading up to Canada's Yukon territory to do a site visit for Banyan Gold, and Yukon as an investment theme will be the subject of our next Rural Investment newsletter. So sit tight, there'll be a lot more to come from Banyan Gold, or about Banyan Gold and the Yukon in general. We're pretty much out of time, Rick. Any final comments that you'd like to make?
Well, again, a naked commercial announcement. I would ask people who didn't attend the conference, either live or live stream, to consider purchasing the recordings. If after purchasing the recordings and reviewing the recordings, you don't think you got your money's worth, I'll give you your money back. That's no financial risk investment, and those are very, very, very rare. Also, the conference and this letter, the boot camps, are all meant to be used in conjunction with the Rural Classroom. There's weekly questions and answers where, yes, people ask me about companies, and I try to use the question as a platform for a lesson, as opposed to merely giving people a stock ranking. But the point is that the process of making yourself a better investor is something that never ends. It's a 365-day a year challenge, and we will attempt to be there for you in an integrated fashion for 365 days. Absolutely, positively, read the newsletter. If you have questions, absolutely, positively pose those questions at the Rural Classroom. If we offer up a boot camp, a deep dive on a subject that interests you, by all means attend the boot camp and attend the symposium too. Just remember, never, ever, ever quit. This is a 365-day a year job.
Excellent. Thank you, Rick. As mentioned, the next Rural Investment newsletter will focus on Yukon. And so our next Q&A will be about Yukon. That hopefully will be in about 1 month's time. So start sharpening your pencils and prepare your questions about Yukon. Rick, been wonderful as always. Thank you very much for joining me today.
A pleasure, sir. Thank you for your contributions, first of all, to the conference, but all of us also for your ongoing efforts with regards to the newsletter and these discussions. It's been a pleasure to work with you.
You're more than welcome, and I echo that. It's been a pleasure working with you as well. And to our audience, thank you very much for joining us. We appreciate your questions. We learn a lot by reading your questions and finding out what it is you want to know or where you see information gaps. So we really appreciate that. Keep those coming. And until next time, thank you very much and have a good month.